Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm joined here as a co-host today, Kyle Ryan, also a certified financial planner, also a chartered financial consultant. Thank you for joining.
Thanks for having me.
Really proud and happy to have as our guest today Brad Sorensen, who's a chartered financial analyst. That's a CFA. We highly regard the CFA designation. These guys are the investment gurus. And Brad also works for Cornerstone Portfolio Research, which is a private group of CFAs who provide consulting services to companies like ourselves. So Brad gets to see our pretty face, or we get to see his pretty face every week as we're going through some things. So we go through the economy, et cetera. What we're going to do here is, this is going to be at least a two-part episode, or two episodes. First episode that we're going to do today is going to be split into two segments. We're going to talk about last year, what happened last year. Then the second half is going to be current conditions. And then what we're going to do is we're going to go into next week, which we're going to be talking about the outlook for 2025. So Brad, thank you very much for joining us.
Thanks for having me. Happy to be here.
Thank you. Thank you. So walk us through what happened in 2024.
Oh, well, it was just a regular boring year. We just had an election, an Olympics, a Fed change, and various presidential assassination attempts. So let's just get to it.
Oh, yeah. Other than that, it was very, exactly. We have that every year.
What really happened, we saw S&P over 20%. Second year in a row, the S&P was up over 20%. Everybody says, that's great. Everybody's happy. But then when you dig down in those numbers a little bit, not quite as good, because those gains were pretty concentrated into the top 4, 5, 6, 7, Mag 7 type stocks, the Teslas, the Apples, the Nvidias, which everybody knows about, that those really drove the gains. If you strip those out, it was more on the average of the other 493 were around 10 to 12% for the year. So it was a good year, a great year for some, and we saw a lot of active managers underperform because they just couldn't own enough of those 7 stocks to keep up with the S&P 500 market. So it was kind of an interesting year and a frustrating year for some active mutual fund managers. But we did see some signs of broadening out, that investors are starting to at least get interested in, for example, small cap stocks. Their valuations are much lower. And after the presidential election, there was hopes and beliefs that the new administration would be more friendly towards small company stocks. So that helped those kind of gain a little more interest among investors. And we think that is a healthy thing for the market to broaden out a little bit.
Good. Well, one of the things that you pointed out, and you provided a really nice slide on this, it shows that over the course of the last 4 years, how the Magnificent Seven, for those of you who, Brad said Mag 7, it's Magnificent Seven is the term that they've more recently used in the last couple of years. This chart shows that over the course of the last 4 years, those 4 stocks have actually grown by 120%, and the S&P 500 has grown by 58%, yet the other stocks are only at 28%, or from an annualized basis, the Magnificent Seven has grown 22% annually, which is magnificent, right? And that even includes 2022, where they all got smoked. And then the S&P 500 over that same period is averaging 12%. But as we refer to around here, the S&P 493, which there really isn't one, but it's the S&P 400 less those 7 stocks. So to Brad's point, those 7 companies have led the charge and falsely given the appearance, maybe not falsely, but given the appearance that the market's doing really well, but it's driven by just a small handful of stocks.
Yeah, and the risk in that, I'm glad you pointed out that chart, because if you look back to 22, we can see that those were high flyers, but then they have a lot more air under them to come down if there's a bump in the road. That's why we warn against having too much concentration. But it does get frustrating at times for some investors, because if you're not loaded up on those Magnificent Seven, And it got even narrower than that. Like after the election, we saw Tesla, because of Elon Musk's perceived or actual contact with the administration and influence on the administration, Tesla took off. And that really drove the whole Mag 7 up towards this latter half of last year. So, and that's just things you don't want to really invest all your eggs into one basket. That's why we got a little nervous that investors would get frustrated and just want to own those 7 stocks. And that's why we go back to 22 and say, hey, this is what can happen when you get overly concentrated.
Well,
Well,
when we look at the last 2 years, Brad, 24 and even 2023, the Magnificent Seven, they absolutely dominated the market, and the S&P, the Nasdaq really were buoyed from them. But is it because they were truly growing that much? Was it the likes of AI and the optimism behind it that helped them just soar above? Are they making the money that other companies in the S&P 500 aren't making to give them a reason to outperform this much, or is it really just optimism on the future behind investments in AI and the likes?
Yeah, that's a great point that a lot of people have compared this to the late 90s and the internet bubble. And the big difference is what you point out, that these companies, the vast majority of them, like the Nvidias, the Apples, they are making money. They're like Nvidia has orders that it can't fill out as far as the eye can see. So it's a combination of those two things. Stocks always trade on forward expectations, but Nvidia keeps raising those forward expectations because demand for AI chips that they make keeps going up. Now, the law of, and we talked about this a million times, but like the law of large numbers, there's only so many companies out there. There's only so much money that there is a limit to this. And that's why we've seen a little more caution in the latter half of 24 that, hey, these AI may change the world, but it's going to take some time to recognize revenue from that. And these companies aren't going to keep being able to spend as much as they are on all of this AI technology at the rate that they are. So some of those expectations got a little ahead of themselves, as always happens in the market. But that, so I guess to kind of cop out of your question, it was a combination of the two. They are earning money, but it is the expected AI changing the universe sort of idea that really enthused a lot of investors to get into those stocks.
Yeah, and we use the example here. We talk about how when the internet came about, how are companies going to make money on the internet? At first, it might seem, you can't make sense of it, but all of a sudden they figure it out through advertising and other means that all the I mean, just like you said, the dot-com bubble was different. Certain companies making absolutely no money going up the percentages they were. It's not quite the case in this, but it's still, making sure that these companies can truly make money off the AI that they're investing so heavily into. And if they're not, I'd imagine shareholders are going to get concerned, and some of the air can come out of the sales, just like we saw in 2022. The bigger you are, the harder you fall.
and you also pointed that out in the past too, in that there's only so much, and
Yeah, and that's it. And yeah, I will use, you make a great point that you can go back and like the Nvidias, those kind of companies right now are like the Cisco's back then. They're providing the guts of AI. They're providing what, and Cisco is still a great company, but its growth rate is leveled off and it's not considered a really growth company. It's a stable, mature company now. That's more what I see with AI, that this initial infrastructure, that's where everybody's excited. But going forward, it'll be the people using the AI and those that figure out how to monetize that AI. If you, this will sound ridiculous, but if you look back to 2000 and I had told you that this kind of tiny bookseller on the internet was going to be the big winner over the next 20 years, like people listening, I'm getting older, but people may not remember that. But Amazon used to just sell books. That was all they did. And then they started to add things, and investors were worried that they were getting over their skis a little bit. They were getting out of their core competency. Well, we saw they learned how to do it, and obviously they took off. And now we know that nobody can live without Amazon. So there's going to be those kind of AI companies. It's just what companies are those going to be? That's going to be the next game that investors have to try to play for those that want to play that single stock or several stock type game.
And
Well,
okay. I was going to say there's been really strong earnings growth, but earnings growth really can't come without strong economic activity, and the economy's been absolutely booming. I just think back, I think it was March of 23, where there was some cracks. We started talking about cracks in the economy, the banks starting to falter, and there was no, at least, through our conversation, it didn't seem like there was that many concerns. Interest rates remained elevated for so long, they were plateaued. We've only just started cutting. So, and it seems like a unique environment where we had elevating interest rates, and there really weren't, not only not cracks in the economy, but it just kept growing at a really strong pace.
Yeah, it is very unique, and it has surprised a lot of investors that before the Fed has, when they've raised rates, it has resulted in a severe economic slowdown, at least, if not a recession. So the fact that we really haven't had that yet, and I want to caveat that because they're not done, and we still have time for that to happen, but I'm not saying that's going to happen. It's just, I don't know if we remember back, but it's not mission accomplished quite yet. The Powell hasn't planted the flag that, hey, we've conquered inflation, so we're still dealing with that. But to this point, you're right, the economy has remained extremely strong considering we've had 4+% of rate hikes. It's not even just the absolute level, but the change. When you go to 1 to 5%, a 500% increase, that's a huge change in the economy. And that we've been able to weather that is a testament to the strength of the U.S. economy and the resilience of the U.S. economy. Also, a testament, which we'll probably talk about later, to the amount of money that the government's been pumping into the economy.
exactly. Well, so the concern that we had, and we've talked about this on numerous occasions, and I think the monetary policy and just flooding the country with money has pushed out the recession. But a couple of the indicators that we always looked at that have historically been 100% indicators that a recession is coming are leading economic indicators, where every time that they've gone negative, it was followed about 8 to 12 months later by a recession. And then the yield curve inverting, which again, 8 to 12 or 12 months later is followed by a recession. And these went negative 2.5 years ago and nothing.
Well, that's where I love the saying Brad taught us: a recession delayed is not a recession denied.
Yeah, and that's what I do want to say. That's why I say, look, we're not done yet, and there's been Fed members talking about that. But I have been surprised, and I think a lot of investors, because that's been one of the adages for years and years that the Fed hikes, the curve inverts, recession follows in 12 to 18 months is usually the kind of time frame that we look at. But this is a unique time. As Mike mentioned, there was a lot of cash in the economy from the COVID era that was still out there flowing around. And then oftentimes you'll see the fiscal side, which is the government spending side, and the monetary side, which is the Federal Reserve side. They try to act in concert because they kind of have the same goals. They want to keep inflation down and employment high, so they still do the same thing. We saw them moving in opposite directions this time, where the Fed was tightening, trying to bring inflation down, but the government kept spending on the fiscal side, kept putting money out there, and that helps to buoy the economy and weather those rate hikes.
And also helps to raise our debt levels.
Yes.
So this is a good breaking point where we're going to transition into talking about the current economy. But the one thing that I would like to do as a transition when we return on the next segment is to stay with those particular Magnificent Seven and talk about the PEs and are they potentially in a bubble. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're here still with Brad Sorensen, Chartered Financial Analyst. We talked in the first segment about what happened in 2024, and it seems to be focused on a lot of things driven by the election. The markets had done really well for the second year in a row, and it was driven again by the Magnificent Seven or the artificial intelligence stocks. We talked about that last. We're going to now talk about where the current conditions are, but as a transition into it, what I'd like to do, Brad, fill me in a little bit, because one of the things that concerns me a tad is, as it pertains to those Magnificent Seven stocks, it's very easy to say, hey, fear of missing out, let's jump in. But at the same time, too, I'm looking at it and saying, hey, they got a PE ratio that's 2 to 3 times that of the regular market or the rest of the market, and you can share better than that. Are we, if it's twice the value of the market, does that mean it's overpriced 2 times and can come back down? That's the concern we have on behalf of our clients. Can you share a little bit about the PEs, and are we in a bubble?
Right. The bubble word is probably a bit much, but overvalued. So let's just take one step back. Historically, the S&P 500 PE, that's the price of the stock per earnings per share of stock. That's what PE is. The ratio of that has been around 17.5 to 18. And there are some arguments that maybe we should deserve a higher one due to the exceptionalism of the United States, the Federal Reserve being a backstop for anything that would happen, those kind of things. So that's an argument we can have later. But historically, just for reference sake, it's 17 after 18. Right now, the Mag 7 is closer to 30. So almost twice what the historical average is. The other 493 are in the 19 to 20 range. And I say ranges because it changes daily based on the price and the earnings estimates, but that's the range that it's been in for the last quarter. So there's quite a bit, that's a big difference there. So what that means for investors is, we always say valuation isn't a timing tool. We constantly preach, don't try to time the market, because there's a lot of people that try to do that with a lot better tools than you have. But it's not a great timing tool. Stocks can stay overvalued for a long time, but the risk is that there's a lot further to come down if we see a bump, if we see inflation flare up, the Fed have to tighten again, a misstep in global economies. There's a lot of things that can go wrong, and the stocks in the Mag 7 are priced to keep growing and nothing goes wrong. That orders keep coming in at the same rate. And if that stops happening, then they have the 20-30% to come down, where the rest of the stocks, they're already down 20% from the Mag 7 in terms of valuation. So they have less of a room to come down, and expectations aren't as high. So they have more room to surprise on the upside. So the risk return ratio is just skewed right now, where the Mag 7 really can't make a misstep, where the other parts of the market can weather a few things because they're not priced to perfection, as we say.
Right. In other words, they're priced to grow at these ridiculous rates that they've been growing over the past several years.
Right. Almost in perpetuity, that's going to just keep coming. Well, that can't possibly happen. There's just not enough money in the world for them to keep going at these rates. And we're starting to see, incidentally, boards of directors, that's who's in charge of the companies at the end of the day. That's who tells the CEOs what to do. They're the ones that are starting to ask some questions about the capital expenditures on AI. Do we need to keep spending this much money? I don't know that it's going to curtail it immediately, but the questions are starting to be asked.
I always thought, can you touch on the impact that interest rates have on price to PE ratios? Because, before the effectively a reset of the market in 2022, go back to 2020, 2021, interest rates were really low. And I remember hearing, you could justify higher PE ratios in environments where you have lower interest rates. Now we obviously have more elevated interest rates, more in line with historical averages, whereas companies' valuations are still, I don't know if they're in the exact same ratio, but they're still elevated. When you look at the Magnificent Seven, a lot of them are flush with cash. I don't know if that has anything to do with their ability to borrow and continue to trade at these higher ratios, but how does interest rates play on that, and does their boatload of cash that these companies have anything to do with their ability to achieve these higher PE ratios?
Yeah, great question. So I'll try to simplify it because I can get pretty far into the weeds when you start getting into interest rates. But interest rates have a huge impact on these things. And yeah, so in two ways. One, company borrowing money that they borrow at higher rates or lower rates, that helps. And we see that a lot at the small end. That helps the small end. But then it's alternative investments as well. Can you invest? It was called TINA. There is no alternative. You had to invest in stocks because anything else you were getting less than 1% on. So there's no reason to invest. Put it on your mattress or invest in stocks. Those were kind of the two options back in 2021. Also, third way, I said two, there's actually three, that looking forward, you look at those revenues in 28, 29, 30. Like I said, stock market's forward looking. And then you, what's called discounts. So you bring those back at the interest rate that you have. So higher interest rates means that those are worth less in the future. So lower interest rates mean they're worth more. So when you see interest rates go up, usually really high growth stocks will fall because their future cash flows are less valuable due to the higher interest rates. We've seen some of that as the interest rate has been much more volatile. We look at the 10-year treasury, that's kind of the benchmark rate. And in the past, people have just started paying attention, wouldn't know this, but in the past, a 5 or 10 basis point move in a couple of days would be a pretty big move. That's a huge market. Billions and billions and billions of dollars are traded globally in the 10-year treasury. Well, it's been moving 10, 15 points a day oftentimes over the past couple of years. So that's just been a lot more volatile. And we've seen stocks often react in an opposite direction of that because of those issues.
So you referenced earlier, which is a great, that things are beginning to taper off towards the end of 2024 and into now. That it seems as though the rest of the market it's broadening out. So it kind of takes us a little bit into where we are today, which coincidentally is we're in the teeth of earnings. Not in the teeth of, we're at the very beginning of earnings season. And my understanding is that the banks typically lead off the earnings season, and the banks have been knocking the cover off the ball, or is it some banks?
No, the major banks have all reported really good earnings so far. JP, Citi, Bank of America, Goldman, they've all done really well.
Good. So where are we kind of at now so that we can, we're starting earnings season. We're beginning to see a rotation, a shift, although I'm very cautious about that because I've seen so many head fakes in my experience that I'm afraid to think something's happening when in fact it only does it for a week or two.
Yeah, and that's a great point. That's why I never want to say we're seeing that. We've seen signs of the broadening. Now, whether it can continue, we'll see. So, what the market does, just we'll go over the last 2 months to current because it explains what's happening currently. Obviously, the election back in November was taking all of the oxygen out of the room. That was what everybody was focused on. And it wasn't even necessarily the candidates, it was just get a result. They didn't want, there was a fear, and it's maybe hard to remember, but there was a fear that it would drag on for months and legal fights. And well, the market was relieved when we had an answer Tuesday night that the winner was, and then there was some enthusiasm that Trump is considered a more business friendly candidate. Well, the market took off. So markets focused on that. Then they were worried about interest rates, so the market fell a little bit. So then the market focused on interest rates and what the Fed was going to do. And that's what's happened over the last week. We saw a strong labor report. Market tanked. Mike and I have joked about this. Hey, more people are working. Let's sell stocks. Well, yeah, that doesn't make a lot of sense, but they're worried about inflation going up and the Fed having to be tighter in monetary policy, which has longer term consequences on that. So that's why the market was concerned about that. But then this week, we've gotten some mildly softer inflation readings. So that's eased market concerns. And we've seen the market rally back. So interest rates have taken the oxygen from the market. And now, as you mentioned, we're starting to enter the heart of earnings season. Really, next week, it starts to heat up a lot. In the last 2 weeks of January, we'll get almost, I think, 80% of the 500 reporting. Although, just as a note, NVIDIA is always really late. They'll be probably second or third week of February before they actually do. But because everybody pays attention to them. So that's what the market, barring some huge exogenous force, that's what will drive the market over the next couple of weeks and really ultimately drives the market over the long term. It's how companies grow their earnings and what they say about the earnings going forward. It'll be volatile based on all these other things, but all those other things feed back into earnings, and that's what investors care about.
Well, of course, and it all comes down to the earnings as the value of the stock. And to your point, what has happened over the course of the past 2 months, November was really strong because of the relief of the election is over with an answer, and the markets took off. And then all of a sudden, December, things started petering out. In fact, we had a pretty lousy month. The old Santa Claus rally didn't happen. Santa Claus didn't show up this year. And we had a pretty tough December going into January. And that was, to your point, related to concerns about inflation coming back. And then we got a good CPI report earlier in the week that helped defray that. But I don't think we're out of the woods yet. But what that's telling me is that the markets are paying a tremendous amount of attention to inflation and interest rates. But hopefully that shifts to the fundamentals being the earnings.
Exactly. Yeah, they are, because that's what, so they've modeled out, analysts and investors have said, X company is going to earn this, and that's worth this much money, so we'll buy the stock at this price. Well, then if their expectations for interest rates change, they have to redo all that. If they think interest rates are going to be higher, they have to reduce those rates and bring down stocks. So obviously there's more emotion in there in the short term. There's knee-jerk responses. That's why we don't pay a lot of attention to just day to day. But that's the fundamental reasons why these things happen, is because these earning estimates, it all comes back to earnings, like you said, that the earnings estimates get changed because of their view of the interest rates. It has to change those earnings potential.
Is there anything else you want to add? We're wrapping up on this episode, Brad. So we talked in the first segment of what happened last year, kind of talking now about current conditions. And what we'll do is we'll blend and transition into the future outlook. But is there anything else that you want to add?
Well, the last thing I want to add was about interest rates, and part of it was inflation, and we'll talk about this in the future, but investors are starting to be concerned about the deficit. So that also played a part in that, and the amount of government spending. So that's always a great topic of discussion. Everybody loves to talk about government spending. So that's the other thing I would point out, is that also had an impact on the perceived Trump spending plans, had an impact on interest rates.
Very good. All right, thank you very much, Brad. I appreciate you taking the time. And then what we'll do is in the next segment, what we'll do is we'll be starting to talk about the future and the future outlook. So thank you very much for joining us, and we look forward to seeing you in the next episode. Have a wonderful, wonderful day. Thank you.